Finance is called as the lifeblood of business. With these words, I, CA Jyoti Sapna Madan, will help you more detail about business finance. Business finance is a combination of two words, that's a business and finance. What is business? Business is the production and distribution of goods and services for the satisfaction of society. But for doing business, what we required? We required money, fund. Fund is what? A finance. Without finance, without fund, the business cannot survive. So, a combination of business and the fund, that is finance. We get the word business finance. The second point is that why the finance is very needed for the success of business. Yes, finance is very important. There are multiple points we required finance. We will go in detail about this. First point, that is maximization of profit. Yes, if there will be no finance, we are not able to earn more profit. As we required more money in the business, we can earn more and more profit. The second point, if we proceed, that is proper arrangement of working capital. We required finance for day-to-day operations of the work. Every activity required money, fund. Yes, then finance is the lifeblood of business. Third point, that is, it helps in the distribution of income. If we have proper finance, we can distribute that income in the proper channelized way. The fourth point, if we come up, that is helpful in the liquidity check. See, if we have finance in a proper way, we can have the liquid cash and we can use it in the working of the business. Next point, that is the fifth point, it is helpful in acquiring material and instrument. What we required in doing the business? Yes, we required the raw material, we required the working material, we required fixed assets, and for that we required finance. Therefore, finance helps in acquiring the raw material, which is very necessary for doing the business. Sixth point, that it helpful in the decision making regarding solvency. See guys, if we have the funds, we are able to be very solvent. If we are not having the finance, we are not much solvent. For becoming a more solvent, what we required? We required money and finance. Therefore, the businessman who is having a more money, a more fund, more finance, they will be more useful in their decision making power also. Seventh point, it helps in the preparing of the prospective expansion plans. See, if we have the more finance in the business, we can go for the diversification. We can go for the expansion in the different field areas. We can increase our business plan. We can increase the size of the growth rate, right? Coming up to the next point, that is the eighth point, very, very important point. It helps in preparing the sales and the credit policy. Students, if we have the good finance, we are able to get the credit facilities available to the clients. If we have more money in hand, we can give the credit facilities and we can survive in the competitive world. As our competitors, what they are doing, they're giving more credit. They are using the funds properly. Same way, if the businessman is using the funds in the proper way, they can be using the credit policy in a proper manner. Next point, for business, only ma'am, fixed capital is required? No, answer is no. We required a fixed capital as well as the working capital. What is the difference between the fixed capital and working capital? We go detail in about what is exactly fixed capital is. Fixed capital is required for the permanent period, for long time period, for the growth of the business. For example, if I required land, building, plant, machinery, for that I required money that will be blocked for long period of time. So that capital will be called as a fixed capital. Usually this type of capital is required for expansions, for increasing the business growth rates, for expansion, diversification, we required fixed capital. The second capital is, that is a working capital. For day-to-day business activity, we just not depend on the fixed capital. We require the liquid capital, that is the working capital. For doing the day-to-day business, day-to-day transaction, we required money in the form of a liquid. That liquid is called as a working capital. But the point is that how we have to decide how much fixed capital is required and how much working capital is required, and what are the points to be considered while taking a decision of fixed capital and working capital. So my next point is factors affecting fixed capital. There are multiple factors which affect the fixed capital. For that we have to be more clear, like the first point, that is a growth prospectus. For requiring the growth of the business, what we required more land and building, we required more furniture. For that means the fixed capital requirement will be increases. But if we are going to the second point, that is a diversification. When I need to diversify my business in a different channelized way, I want to be more expendable. Again, I required more working capital. You can understand properly, when are increasing our business, we are needed a fixed capital, more fixed capital. Coming up to the third point, that is a joint venture. See students, if we are doing the business in the combination, like for making a joint venture with the other person, yes, definitely we are using the fixed assets of other person also. That means for that time we required less fixed capital as compared to working capital. Coming up to the third point, that is a production technique. Basically we have two production technique, that is a capital intensive technique and the labor intensive technique. If we are using a more capital intensive technique, that means we required more fixed capital as compared to working capital. But if I am using a labor intensive technique, we required less fixed working capital as compared to fixed capital. Coming up to the next point, what are the factors that are affecting the working capital? As we already discussed what is working capital, now we are discussing about the factors which are affecting the working capital. The first point is the nature of business. Students, if we are having a nature of trading, like purchasing the goods and just distributing it, we require more working capital as compared to fixed capital. But if my nature of business is manufacturing, like I have to do lots of work, lots of activity, we required more and more of working capital as compared to trading business. In trading business, what we used to do, we used to purchase the goods and distribute it. That means we don't require much of the capital. Second point is the raw material availability. If we have the good quality of raw material, like if we are having a seasonal product, we are using it for the season product, then we required a large amount of working capital. But my product is not very seasonal, it is for the day-to-day working, so that means we are not blocked with the money, we required less working capital. Coming up to the third point, operating efficiency. If my business is working very effectively, like regularly goods are produced and sale up, that my money is less blocked up. Therefore, the requirement for working capital will be less. But my business is not so much effectively working properly, and that time we required, tell me, required more capital or less capital? If my working is properly, like producing, selling, that means less amount is blocked, right? But if my product is produced and sale up after a long time period, that means my money is blocked up, working capital will be more, right? Coming up to the next point, competition. In today's world, there is a lot of competition. If you want to survive in the competitive level, you need fund, you need money. For that means, if you want to survive in the competitive world, you require more working capital as compared to the less competitive world. For example, if I am selling that product which is having a monopoly, that is my product, that means I don't need to have much fund in that business. I can use less amount of capital and can survive properly. Now the new topic, that's the different sources of finance, from where we get the money. We have divided the sources of finance into basically three parts, like on the basis of the periods, on the basis of the ownership, and the third point, that is on the basis of the source of generation. If we are talking about on the basis of time period, we divided the business finance into three categories: long-term sources, medium-term, and the short-term sources. If we are talking about the ownership, from where we get the money, basically ownership, that means the owned fund. Owned fund, and the reverse of owned fund is borrowed fund. The third category, that is the income source of generation. From where I am getting the source of fund? I am getting the source of from internal, that is internal sources, and second is your external sources. Now we'll go more detail in all these sources one by one. We start with the long-term sources. Long-term source of funds are those source of fund which is for more than a period exceeding 5 years. That means if I require money for more than 5 years, that will become under the period of long-term sources. For long-term sources of funds, if I collected the money from the market for long period, for that, what I use with that money? What I do with that money? Definitely, I use it for long-term funds. Like for example, I can issue the shares, right? I can issue the debenture, and with that money, I can invest more and more in my business. I can acquire more shares, I can acquire more land and building, right? Now, if I am coming up to the third category, that is a medium-term sources of finance. This is a time period of more than 1 year, but that is less than 5 years. Above 5 years, it is a long time. 1 to 5 will be medium term, right? For that, what we issue in the market to get the medium term of money, that is from borrows from the banks, lease financing, right? And you can use the public deposit also, because the public can easily give you a money for 1 to 5 years. But if I'm talking about more than 5 years, can I go for the public deposit? The answer will be no. Now coming up to the third category, that is a short-term source of fund. If I'm talking about the short term, a small term, that is a term period of 1 year, within 1 year. I need a money only for 1 year. That is, I require the money for the short term sources. For this, what we require, we can issue the loan from the commercial banks, we can take the trade credit, we can issue factoring, commercial papers and many more. Ma'am, what are these terms? We'll explain you all these terms with their merits and demerits in a next session. If I'm talking about the second category, that is based on ownership, we have just discussed about, we have two types of own fund and one is the borrowed fund. Ma'am, what is exactly own fund is? That means the owner itself invested their money and they are not expecting even return of dividend. They are not expecting that I should get the dividend regularly, because they invested their business, they invested the money in the business for the long-term growth. They want the capital appreciation. This type of fund is called as owned fund. And for that, what we require, like in the form of equity shares. Normally, equity shares are the form of an owned fund. But if I am talking about the borrowed fund, yes, I've purchased, I've taken the money from the public, from the outsiders, and for that we have to give the interest regularly. Even if we are not having the profit, we have to give them the interest. That type of funds are borrowed fund. Every item over here, every point over there have their own merits and demerits. We can't judge this one is much better as compared to this one, right? This is own fund, which we have discussed up. How we can issue the own fund? With the help of equity shares, with the help of retained earning, and not only equity share, we can issue the preference shares also, right? But the main purpose of own fund is that we not need to give the dividend regularly. If I invested the money as an own fund, we can say it that we get the capital appreciation. We increase your money, right? And if I'm talking about the borrowed fund, we have to give the fixed interval, fixed interest regularly, and without saying that if I am not having profit, I can't give you interest. This cannot be possible if I purchase the money from the borrowed fund. Now the third category, that is based on the sources of generation. I have generated the money from outside. So from which source I generated? There are two categories of sources. First is internal sources and second is your external sources. Go for the detail. Internal sources, what are internal sources? Like I have generated the money for my own purpose, from the internal, from their owners, right? And from external sources, from outsiders, I have taken the money. Now we go in more details about each and every elements which we have discussed now. Different sources and their different points, right? The first point is issue of share. The very important point is issue of share. If I'm talking about issue of shares, that means a unit, a company issue the unit and take the money from that party. If I've given the unit to some person, issue my shares, and then I take the money and invest in my business, right? Once a company issued a capital of rupees 1 lakh at a rate of rupees 10 each, that means 10,000 shares he has issued in the business. I have purchased only one share. One share is of rupees 100. Okay, that means I have invested 100 rupees in that business. But the point is that, ma'am, is the issue of equity shares or a preference share, is which one, if I compare, which one is better? Both have their merits and demerits, which we'll discuss in this session only. If I'm talking about equity share is always considered to be much better. Why? Because we become the owner of that fund and we don't have to pay interest in dividend to that person. This is also known as a residual ownership, because whatever the amount we have invested in that business. Now the first point of merit, if I'm talking about the merit of equity share, no obligation to pay. I just discussed up, if I've taken the money from the equity share, I don't need to pay the dividend. If I have a good amount of profit, I can pay up, right? The second point, shared risk. Yes, if I've taken the person and accepted as an equity share, my risk of the business will be shared between both of them, right? No fixed commitment. That means there is no commitment. I won't pay you any sort of dividend. If I have the profit, I will definitely pay you. But there is no fixed commitment to pay back your dividend to that person. But there are demerit. First is the demerit is dilution of ownership. My control, my power of taking the decision will be controlled between that party. If I accepted more shares in the market, from the market, my control, my diversion will be there. Second point, cost of equity. That's the most important. We discuss the cost of capital in the next session, and in that we discuss more detail about how we calculate the cost of equity. The cost of equity will be very high. Why so? Because we have to pay the growth companies have to pay the dividend. But ma'am, it's compulsory to pay the dividend. Of course, the equity shareholder will expect some sort of dividend. Loss of autonomy, that is the power of taking the decision. If I'm alone in the business, definitely the decision will be mine only. But if some person is also taking control of my business, then the decision will be diluted. Autonomy will be diluted between that person. The next second point, first we have discussed about equity share, now we are discussing about the preference shares. What is preference shares? Preference shares, the name itself suggests preference, more preference as compared to equity. That means the preference shareholder have the right to receive the fixed rate of dividend. And in the time of liquidation, what happens? If there is a liquidation, the company is not having the money, the first person will be the creditor and the second person will be the preference shareholder. They get their money back as compared to the equity shareholder, we get the last opportunity in the case of a liquidation. Again, there are some merits for issuing the preference share. What are those merits? First point, fixed dividend. Yes, fixed dividend will be given to the preference shareholder. But fixed amount is decided or fixed percentage? Yes, the fixed percentage is decided that from profit a 30%, 10%, 12% dividend will be given to the preference shareholder. But as compared to equity, there is no fixed rate of dividend. Second point, priority in liquidation. We just discussed at the time of liquidation, the more priority to pay their money will be given to preference shareholder. Equity shareholder will not come up. Okay. Coming up to the third point, that is a voting right. Yes, this is a merit. A demerit can also be there. If I've taken the money from the preference shareholder has no voting rights. That means they are no right to control my business. For small business, it is good. Like they don't want someone come up and involve in my business, right? So that is a merit that no voting rights will be there for the preference shareholder, and in return what they get it? They get it a fixed amount of dividend or a fixed rate of dividend. If I'm coming up to the fourth point, less risk compared to equity. Yes, the preference shareholder are less risky. Why so? A fixed amount of dividend they get it, right? At the time of liquidation, they get their money back. So that means the less risky as compared to equity. But that means, ma'am, the preference is much better. The answer is no. Every coin has both the toes, right? Head and tail. Therefore, we have the demerit of this also. The first demerit is fixed dividend may limit the growth. The business is earning so high, but what the preference shareholder getting? Just a penny of 10%, 20%, 12%, 15% of dividend. That means there will be no growth for the preference shareholder. Second point, not participating in the growth company. If the company wants, or if the company is getting in a very high priority of growth, the preference shareholder want to involve in that company, but the preference shareholder has no right, they have no right to participate, right? So this is again a demerit for the preference shareholder. If I am coming up to the third point, we already discussed like limited voting rights. They have some sort of voting rights, as preference shareholders have many types. They have the voting rights but limited. Every time they are not allowed to come and do the votings, do the meetings, attend the meetings. The fourth point, higher cost of capital. Yes, we have to pay the dividend to the preference shareholder, therefore their cost of capital is high. This point is somehow the same for the equity and preference. Equity also get the dividend, but less amount of dividend as compared to preference, because the preference dividend is always been fixed. Now coming up to the third category. This is a category of debenture, a borrowed fund. If I am talking about the previous two, equity and preference, they are the category of owned fund, mera khud ka paisa. If I am coming up to the second category, that is a debenture. They are like a borrowed fund. We issue the debenture like an instrument. Debenture is just like an instrument in the form of a debt capital. We can take the money for long-term period from the debentures, and in return what we have to pay? Again, a rate of interest. Minded students, there is two words, that is a dividend and interest. If I am talking about the equity shares and preference shares, we have to pay dividend. If I am talking about the debenture, bank loan, what we have to pay? That we have to pay an interest. And whenever we pay the interest, there is a benefit in taxation, that we get the tax benefit. That will be discussed in Income Tax Act 1961. Yes, while paying the interest to the debenture holder, we get the tax exemption. Everyone wants to lower their tax, no? So that's an important point. Okay, they are also termed as a one more important word, creditor. Creditors are from where we have take the money, we have to pay them. Yes, we have to pay back the money to the debenture holder. Again, there are some merits and demerits. If I am talking about the merits, the first point, fixed obligation. The debenture holder will be very happy that he will get the money back in terms of a rate of interest. He is very happy that at least I get the fixed rate of debenture. Okay. If I am talking about second point, see the tax deductible. If I pay the interest to the debenture holder, what the company will get in return for that? It will get the tax benefit, and everyone wants to get the tax benefit. Third point, no dilution of ownership. If I take the money from the debenture holder, there will be no dilution of control. Why so? All control of the company will be taken by the company itself. Debenture holder are just like a borrowed fund. They are just outsiders. They just don't involve in my business. They just, what they needed, they need that interest element. That's it. Again, if I am talking about demerit, yes. There is a merit, then there will be a demerit. Therefore, never judge only on the basis of merit. There is always pros and cons will be there. If I am talking about demerit, this is fixed financial obligation. The company is very bound to pay that interest. Company is not having profit. Still they have to pay the interest. Yes, the answer is yes, they have to pay. That's why from the company point of view, taking money from the debenture sometimes become very considerable point, because they have to fixedly pay that interest. If someone is like standing and requiring the money regularly, you will be financially burdened now. Here I have to pay the money to that person. The first demerit is financial obligation. The second point is risk of over leveraging. What is over leveraging? Over extra. Leveraging responsibility. If I am earning a profit of 100, example, right, I have to pay a 10 rupees of interest. 100, 10 interest I have paid up, 90 rupees will be left out. Okay, but if I am not having enough profit, I am getting in a loss of minus 100, still I have to pay the interest. The answer is yes, I have to pay that interest. That means my total loss will be 110. And the second year again I have to pay the interest. Again there will be a loss. Yes, that means the second point, risk of over leveraging, interest on interest and interest, right? If I am coming up to the third point, collateral requirement. Sometimes the debenture holders are not issued like as in a free. We have to deposit some collateral amount, which is again a burden or demerit for the debenture holder. Just now we have considered three topics, that is first point is equity, second is your preference, now third point we have done up is debenture. Coming up to the next category, that is retained earning. The owner's reserves, which they have kept it for long-term growth and diversification, which they thought of that means we get the money in the form of dividend from the retained earning. What is retained earning basic? That is a plowing back of a profit. From the profit we contributed some amount to some reserves so that it can be used for the business, it can be distributed as a form of a dividend to the equity shareholders, right? Now we are considering the merits and demerits. If I am talking about the merits of retained earning, the first point is cost effective. Yes, it is very less as compared to the cost of retained earning is very less, as it is not very high that we have to pay our interest or we have to pay any dividend. That's why its cost is less. Coming up to the second point, internal. Internal, that is by own. We take the money from the internal pocket only and using it wherever we want to use it. As we don't need to take the money from outsiders, we don't have to take the permission, we don't have to use it in a proper way. As we like to use it, we can use it in that way only. Third point is enhancing the financial stability. Imagine a person is having a more retained earning in their pocket or in their business, that means he is more financially stable. The one who is having a less finance, less retained earning, obviously that he won't able to get more extension in the business. Fourth point, that is a flexible use. Yes, we can use it anywhere, wherever I do feel up. If I want to expand, if I want to diversify, if I want to growth for the company, yes, we can use the retained earning in many forms. Again, there is some demerits for this. That first point is opportunity cost. Ma'am, if you are talking about retained earning, that retained earning is very cost effective, kindly consider the opportunity cost of that. If I am using that money to some other places, might be I am getting the rate of interest. Might be I have to pay that interest. That means we should consider the opportunity cost for using their own money. The second point is limited availability. Sometimes the business is not having a good profit. That means the retained earning will be less amount. And if we are having a less retained earning, we are not able to invest more in the other business. The third demerit of this is shareholder expectation. Yes, sometimes the shareholder expect that the retained earning is very good. I can use that in the form of a dividend. Finally, we get some bonus. But what happened actually, we use that business with that retained amount of fund in the business itself. So sometimes it becomes a very demerit for using the amount of retained earning in the same business. Sometimes what the shareholder expect, they feel like using that money for the growth, expansions, diversification. Even they want dividend, bonus, whatever they want to. What happened actually, you are using that money in that the same business. So that's why sometimes it happens the customer shareholders expectations get conflict and it becomes a matter of discussion. The next category, that is a bank loan. Bank loan is that category which can be used for the small and medium enterprises. They can easily get the loan from the bank. There are again some merits and demerits from the bank taking the loan from the bank. The first point is, the first merit is easily accessible. Yes, you can take the loan from the bank very easily and you can use that in your business also. Second point, flexible terms. Sometimes we use the terms and conditions in the form of using that in the business. We can flexible that terms and condition and take the loan from the banks. The third category is collateral option. Sometimes we have the option not to deposit the collateral also, and sometimes we need to deposit the collateral, right? That will be a good option if we don't have to pay the collateral. The third category is a tax deductible. Yes, I already discussed up. If I am taking any borrowed fund where we have to pay the interest, either in the form of interest to debenture holder, or I have taken a loan from bank, I am paying interest, that will be a benefit of tax deductible. But we have some demerit of this also. Yes, interest cost. The company who has taken a bank loan have to regularly pay the interest to the person from whom I am taken the loan. Collateral requirement we just discussed. Yes, sometime we have to pay the collateral also, and for that amount will be like your collateral will be fixed if I have taken the loan from the bank. The third point is credit risk, very important. Remember, if you have taken the loan from the bank, you have to pay them properly. If you are not paying your installments, that means your CIBIL will get distracted. Your CIBIL will be less, and once your CIBIL will be get less amount, less percentage, then the bank will never lease you a good amount of credit, because your credit risk will increases. And the fourth category is regulatory compliances, rules and regulation. If I am taking the loan from the banks, yes, definitely I have to follow many rules and regulations of the money market instruments, of the regulatory instruments of the RBI. So this is also one of the demerits of taking the money from the bank loan. From all this, what we have concluded, that there are different sources of finances. It is in the form of equity, it is in the form of preference, it is in the form of a debenture, bank loan, commercial paper, factoring, leasing, but all have their own merits and demerits. But can we say we can use their own fund for the business? The answer will be no. And without fund, is the business can survive? The answer will be no. We require the finance for running the business, and that's why we always say that finance is the lifeblood of the business. With this word, thank you.